Hello, hi guys. This is CA Balakrishna from Lecturepedia.in. How are you? Hope you people are doing well. Even I am fantastic. In the today's class, we will revise group audits. Group audits is nothing but audit of consolidated financial statements. Along with this chapter, we will also discuss SA 600 in this lecture itself. Okay. So, starting with the chapter group audits. What are the topics that are covered in this chapter? Firstly, we will cover audit of financial statements. After that, we will cover SA 600, which is use of other auditors work. Next, types of financial statements. You already know that there will be two types of financial statements. One is standalone financial statements. Okay, standalone financial statements will consist of financial statements of only one company. Okay, either the holding company or the subsidiary company or the associate company. The financials of only one company will known as a standalone financial statements. Next, we will be having consolidated financial statements. Now, if a company is having subsidiaries, joint ventures and associates, then it has to prepare consolidated financial statements, consolidating the financial statements of the holding company, subsidiary, associate and joint ventures. Those financial statements will be known as consolidated financial statements. Now, just like standalone financial statements are audited by an auditor, even consolidated financial statements will also be audited by auditor. Now, the entity can appoint same auditor for both standalone financial and consolidated financial statements, or if the entity wants, it can appoint a different auditor for consolidated financial statements. Hope that is clear. Now, understanding the terms that we will be using in this chapter, if you see, we will be using certain terms like parent entity, parent auditor or principal auditor, and component auditor. So let us understand these terms. First of all, there is a company A Limited. This company is parent company because it is having certain subsidiaries and associates. Now, this parent company is having subsidiaries. This parent company is also having associate. See, subsidiary means if you hold more than 51% of shareholding, that becomes your subsidiary. If you hold more than 20% of shareholding, then it becomes associate. And joint venture, this A Limited is also having certain joint ventures with some other company. Now, all these three types of entities will be known as components. Okay, together you can call them as component. Okay, this subsidiary will be component of parent entity, associate will be component of parent entity. Okay, the common term that you can use for all these entities is components. Now, the parent entity will have an auditor. He will be known as parent auditor or principal auditor if he also audits consolidated financial statements. Okay, you will call the auditor of parent entity as parent auditor, and if the same auditor is appointed for auditing consolidated financial statements also, you will call that auditor as principal auditor. Okay, now the components will also be having a auditor, right? This auditor is known as components auditor. Next, what will be included in these consolidated financial statements? Just like the standalone financial statements, even consolidated financial statements also include consolidated balance sheet, consolidated profit and loss statement, consolidated cash flow, consolidated statement of changes in equity and explanatory notes. Now, schedule 3 of Companies Act format for preparation of financial statements, the same format you need to follow even for preparing consolidated financial statements also. And with respect to consolidation, AS 21 and Ind AS 110 deals with this consolidation. And the statutory auditor of consolidated financial statements can be parent's auditor or some other auditor. This point I have already explained to you, right? Next, is it mandatory to prepare consolidated financial statements? If you see, as per Companies Act 2013, if the company is having subsidiaries, it is mandatory for that company to prepare consolidated financial statements. However, there are certain exceptions. What are those exceptions? We will see. There are three types of exceptions. As per Companies Act, there are exceptions. As per Ind AS, there are exceptions. And as per accounting standards, there are exclusions. Okay, as per accounting standard, there is no exemption, but there is an exclusion. We will see what are the exceptions and exclusions available for preparation of consolidated financial statements. But generally speaking, if the company is having subsidiaries, it is mandatory to prepare consolidated financial statements as per Companies Act 2013, and as per Ind AS, as per Accounting Standard 21. Okay, as per these three uh, laws, or as per these three rules, it is mandatory to prepare consolidated financial statements, but there are certain exemptions and exceptions available. See, as per Companies Act, there are exemptions from preparations of consolidated financial statements. We will see that. And as per Ind AS also, there are exemptions. And as per accounting standard, there are only exclusions. Okay, let us see all of them. First of all, requirement as per Companies Act 2013. Now, what Companies Act 2013 says, as per section number 129 subsection 3, where a company has one or more subsidiaries, including associate and joint venture, then it shall, in addition to its own financial statements, prepare a consolidated financial statements. Now it became clear. Companies Act itself makes it mandatory to prepare consolidated financial statements if the company is having subsidiary, and these consolidated financial statements shall also be approved by board of directors and shall be placed in the annual general meeting. Just like standalone financial statements will be approved by board of directors, even the CFS should also be approved by board of directors. Next, a separate statement containing salient features of financial statements of its subsidiary in form AOC1 shall be attached along with these financial statements. See, along with these consolidated financial statements, you will attach a form known as AOC1. What will be there in this AOC1? This AOC1 will contain salient features of the subsidiaries. Okay. Now coming to the exemptions from preparation of consolidated financial statements as per Companies Act 2013. General rule is you have to prepare consolidated financial statements, but if you satisfy the three conditions, okay, if you satisfy all these three conditions together, then you need not prepare consolidated financial statements. What are these three conditions? Let us see. First of all, the company, if it should be either wholly owned subsidiary or partially owned subsidiary of another company, and you should obtain approval from all the shareholders that they do not have any objection for company not preparing consolidated financial statements. Okay, let's say B Limited. B Limited wants to take exemption from preparation of consolidated financial statements. Okay, B Limited is having some subsidiaries and B Limited wanted to take exemption from preparation of consolidated financial statements. Now, what conditions should be satisfied by B Limited? B Limited should be either wholly owned subsidiary or partially owned subsidiary of another company. Let's say B Limited is subsidiary of A Limited. Just a second. So, this is the first condition that has to be satisfied in order to claim exemption. Okay, next, along with this, you should not be either listed entity or not in the process of listing, whether in India or outside India. Okay, this B Limited, it should not be listed entity, or it should not have listed, or it is not in the process of listing either in India or outside India. This is the second condition that needs to be satisfied. And third condition, its ultimate holding company, that is A Limited, which is ultimate holding company of B Limited, should file consolidated financial statements with registrar. Okay, if all these three conditions are satisfied together, then you can claim exemption from preparation of consolidated financial statements. Okay, let's quickly once again go through these conditions. First of all, the company should be either wholly owned subsidiary or partially owned subsidiary of another company, and it should have obtained permission from all its shareholders that they are not having any objection if the company doesn't prepare consolidated financial statements. Next condition, the company is not a listed entity or not in the process of listing whether in India or outside India. Next condition, the company's ultimate holding company should file consolidated financial statements with register. If all these three conditions are satisfied together, then you can claim exemption from preparation of consolidated financial statements as per Companies Act. Okay, there are also exemptions and exclusions as per Ind AS and accounting standards. We will see that now. Next, exemption from preparation of consolidated financial statements as per Indian Accounting Standard 110. Now, if you are an investment company, then you need not prepare consolidated financial statements provided you value your subsidiaries at fair value through profit and loss. Okay. If you are an investment company means your business itself is to purchase and sell various companies. Okay, so since your business itself is to purchase and sell various other companies, in that process you might acquire more than 51% of shareholding of some other company. Even though you have acquired more than 51%, you are an investment company, your intention is to sell them within a period of time. Okay, you just wanted to make a profit by purchasing and selling the shares of that company. You are no way concerned with business of that company, so you need not prepare the consolidated financial statements. Okay, so as per this exemption is as per Ind AS 110. Okay, so if you are an investment entity, you need not prepare consolidated financial statements if you measure all subsidiaries at fair value through profit and loss. Now you can get it out. What is meant by an investment company? There is a definition for that. In order to call an entity as an investment entity, it should satisfy three conditions. What are they? It should obtain funds from one or more investors and provide them investment management services. Okay, investment entity should obtain funds from various investors with an intention to provide investment management services to those investors. Next, with those money, the intention of the investment company is to earn profits either in the form of capital appreciation or in the form of investment income. Investment income means interest and dividend will be known as investment income. So your intention is to earn money through capital appreciation or investment income. See, commits to investors that its business purpose is to invest funds solely for returns from capital appreciation or investment income or both, and it will measure substantially all of its investments on fair value basis. If all these three conditions are satisfied, then you are an investment entity, and if you are an investment entity, you need not prepare consolidated financial statements as per as per Ind AS 110, right? Next, now exclusion as per Accounting Standard 21. See, Accounting Standard 21 doesn't give permanent exemption to any company from preparation of consolidated financial statements. Okay, if you are having a subsidiary, then you have to prepare consolidated financial statements as per Accounting Standard 21, but certain types of subsidiaries can be excluded from your consolidated financial statements. So what are the subsidiaries that can be excluded from consolidated financial statements? See, there could be two reasons for exclusion. First one, relationship of the parent with the subsidiary, associate or jointly controlled entity is intended to be temporary. Okay, if intention of the parent entity is to sell off the subsidiary, joint venture or the associate within a short period of time, okay, that is the period of holding will be very less. Okay, so if the intention of the entity is to sell off the subsidiary within a short period of time, then you need not include that subsidiary in your consolidated financial statements. Now the question arises, what would be known as a temporary period? If the period is less than 12 months, you can call it as a temporary period. Okay, so if you are having any subsidiary, joint venture or associate where your intention is to sell off these components within a short period of time, then you need not include them into your consolidated financial statements. Next, another reason, subsidiary, associate or joint venture operates under severe long-term fund transfer restriction. That means, example, there is a foreign company which is incorporated in USA. Now that foreign company is also having a subsidiary in India. Okay. Now, as per the rules and regulations in India, the foreign company, it cannot take profits from the Indian subsidiary to out of India. So here this subsidiary, it is operating under severe long term fund transfer restriction. So you cannot include this subsidiary into consolidated financial statements. Okay, if you are having any subsidiary where that subsidiary is operating under a severe long term fund transfer restriction, then you cannot include that subsidiary into your consolidated financial statements. So these two types of subsidiaries can be excluded from your consolidated financial statements. So now if you see, accounting standard 21 has not given any exemption from preparation of consolidated financial statements. You have to prepare CFS, but while preparing CFS, you can exclude these two type of uh, subsidiaries or components, you can say. Okay. Next, information used in preparation of consolidated financial statements. Which information you will use for preparing consolidated financial statements? First of all, the separate financial statements of a parent entity and separate financial statements of components you will use for preparation of consolidated financial statements. That is okay. Apart from that, you will also use other financial information not covered by separate financial statements. What will be that? First one is consolidation adjustments, that is you will be having permanent consolidation adjustment and temporary consolidation adjustments. These two will be other information. We will discuss what are these two in the coming slides, and you will also make some disclosures that are to be made in the consolidated financial statements. These disclosures, they will not be there in the standalone financial statements. So this disclosure will become other financial information. Okay. So this is the information that you will use for preparation of consolidated financial statements. Next, responsibility of parent entity with respect to consolidated financial statements. So for preparing consolidated financial statements, what is the responsibility of parent entity? Now, parent entity should identify the components. Okay, it should list down what are all the components that it is having, what subsidiaries it has, what associate it has, what joint ventures it has. It needs to identify all of them. After identifying the components, you need to obtain accurate and complete financial information from these components. Okay, you have to gather accurate information. Next, you should identify reportable segments for the purpose of segment reporting. Then you should also identify related parties and related party transactions for the purpose of disclosure in the consolidated financial statements. Next, you have to make appropriate consolidation adjustments, that is current period consolidation adjustments, permanent consolidation adjustments. Next, you have to harmonize accounting policies and accounting framework. See, if financial statements are prepared as per different accounting policies, then for preparing consolidated financial statements, let's say a component has prepared its financial statements as per a different accounting framework, and the component, let's say for example, this is accounting policy. Now component has valued its inventory at a cost or NRV, whichever is lower, but parent has valued its inventory at a cost. So different accounting policy followed. Now for preparing consolidated financial statements, you need to harmonize all these accounting policies. Same accounting policy has to be followed. Okay, only one accounting policy has to be followed. So that harmonization of accounting policies and accounting framework will also be the responsibility of management. And gap conversion where applicable. Gap conversion means generally accepted accounting principles. Let's say the company is having a foreign subsidiary. Now foreign subsidiary, it will prepare its financial statements as per foreign gap, right, foreign standards. Now for the purpose of consolidation, you have to convert the foreign subsidiaries financial statements into generally accepted accounting principles that is acceptable in India, right? So that gap conversion is also responsibility of management. Auditor will not do this gap conversion. Okay, so all these are the responsibilities of management with respect to consolidated financial statements. Next, responsibilities of auditor with respect to consolidated financial statements. Now, auditor, he needs to satisfy himself that the consolidated financial statements have been prepared as per applicable financial reporting framework. Okay, applicable financial reporting framework means either Ind AS or accounting standards. Okay, the requirements of that applicable financial reporting framework are followed for preparation of CFS. Okay, that needs to be checked by the auditor. Next, express opinion on the true and fair view of these CFS, whether the CFS are showing true and fair view or not. Next, auditor should also report on matters that are present in section 143 subsection 3, just like he reports in case of a standalone financial statements under section 143 subsection 3 of Companies Act. Same reporting. Next, he should also report under section 143 subsection 1. Next, he should verify whether there is the requirement for preparation of consolidated financial statements or not. Okay, only if the company is required to prepare consolidated financial statements, it has to prepare. So whether company is required to prepare or not, you need to see that. Okay, those are the responsibilities of auditor. Next, planning audit of consolidation. Now, how you will plan the audit of consolidation? Let us see. You will first of all understand group structure and group wide controls. Group structure means there will be parent entity. Under parent entity, there will be subsidiary. For subsidiaries, there will be again subsidiary associate. And for parent entity, there will be associate. And for some associates, there will be subsidiaries. So, you need to check the group structure. Okay, this is known as a group structure. You need to understand this group structure and also group wide controls. Next, understanding of accounting policies of parent and its components. Now, what accounting policies the parent is following and what accounting policies the components are following, you need to understand these accounting policies. Next, determining the extent of use of other auditors work. Other auditor means for auditor of the auditor of consolidated financial statements will be known as principal auditor, right? And the auditor of components will be known as other auditor. So you need to determine how much work of other auditor has to be utilized. Next, determining the nature, timing and extent of audit procedures to be performed. That is NTE of audit procedures has to be determined. Next, coordinating the work to be performed. You should coordinate with other auditors with respect to the work that has to be performed. So this is how you will plan audit of consolidation. Next, materiality with respect to consolidated financial statements. Now, for preparing standalone financial statements with respect to audit of standalone financial statements, you will determine a materiality, right? Whether the same materiality can be used even for audit of consolidated financial statements also, or auditor will determine the materiality for consolidated financial statements separately. The answer is he will determine separate materiality for audit of CFS. See, materiality for standalone financial statements will be done component wise. However, in determination of materiality for CFS, auditor should compute the materiality for the group as a whole. Okay, for the entire group he needs to determine the materiality. Next, materiality at group level can be used to determine whether the components financial statements are material to the group or not. Now, for the entire group means what will be included in the group? Parent, its subsidiaries, subsidiaries of subsidiaries, associates, joint ventures, all these together will be known as group. Now, at the entire group level, you will calculate the materiality. Once you have calculated materiality at the entire group level, based on this materiality, you will determine whether the financial statements of component are material to the group or not. Okay. Next, materiality would be considered while considering the observation of the component auditor. Okay, you'll also consider materiality while considering observations that have been made by the component auditor. Now, component auditor might have found that there is a misstatement of worth 1 lakh rupees in the financial statements of one of the component. But if you see the entire turnover of the group, it is 100 crores or 1000 crores. Now, in that 1000 crores, that 1 lakh misstatement is immaterial. So you will consider the materiality at the group level to determine, or while considering the conclusions, or while considering the observations of component auditor. Next, principal auditor can also compute materiality for each component and communicate to the component auditor. See, if the principal auditor wants, principal auditor means the auditor of CFS, he can calculate materiality for each component and he can communicate this materiality to each component if he wants. Okay, this is materiality with respect to consolidated financial statements. Next, completeness of information. Now auditor, he should verify whether complete information has been included in the consolidated financial statements or not. For this purpose, see, auditor shall verify that all components have been included in the consolidated financial statements. In this respect, auditor shall review working papers for the previous years. Okay, the auditor of CFS, he will see working papers of previous year audit to see whether any subsidiaries or any components have been missed in the current year. Next, parents procedure for identification of various components. Okay, what procedures the parent organization or parents management is following for identification of components. You'll see that investment of parent as well as its component. Okay, you will also once go through the investments made by the parent and investments made by the component. See, investment means if a company is investing in other company, there is a chance that that other company might become subsidiary or associate if the investment value exceeds 20% of other company or 51% of shares of other company. So you will go through investment account of parent as well as the investment account of component, right? Next, joint ventures and joint arrangements. You will also verify whether there are any joint ventures and joint arrangements. Starter records maintained by the parent, make inquiries of management to identify any new components. Okay, you will also make inquiry with the management whether any new component can be identified. Okay, any new subsidiary has been acquired during the year. Okay, next, identify the changes in shareholding. Okay, that means in the previous year a particular subsidiary might be there. Okay, subsidiary means, let's say for example in the previous year the shareholding might be 60%, so it became a subsidiary, but in the current year the shareholding reduced to 40% only, so that will not become a subsidiary. So you need to identify changes that has taken place in the shareholding. Okay, next, consolidation adjustments. Now if you see with respect to these consolidation, there are two types of adjustments. One is permanent consolidation adjustments and another one is current period consolidation adjustments. These permanent consolidation adjustments, they will be made only at once. Okay, at the time of acquisition of a subsidiary you will make these permanent consolidations adjustments, and whenever there is a change in say shareholding in the subsidiary, then also you will make these permanent consolidation adjustments. Whereas temporary current period consolidation adjustments you will make in each and every year in which you are preparing consolidated financial statements. So this is the difference between permanent consolidation adjustments and current period consolidation adjustments. See, permanent consolidation adjustments made only on first occasion or subsequent occasion in which there is a change in shareholding, whereas current period consolidation adjustments made in accounting period for which the consolidation of the financial statements is done. Okay, for each and every accounting period for which CFS is prepared, you will make current period consolidation adjustments. There is a list of 10 current period consolidation adjustments and there are two permanent consolidation adjustments that you will make. Let us discuss these consolidation adjustments one by one. Starting with the permanent consolidation adjustments, I have told you there are two permanent consolidation adjustments, right? What are they? First one is determination of goodwill or capital reserve. What is goodwill? Let's say you have purchased a subsidiary at a price more than its value of assets or more than its book value, then goodwill will be created. Let's say you have purchased subsidiary at a lesser price, then capital reserve will be created. So this goodwill or capital reserve, it will be calculated only at the time of acquisition. So it is called as permanent consolidation adjustment. Next, another, the second permanent consolidation adjustment is a calculation of a minority interest or non-controlling interest. Minority interest means both are same. Minority interest, you will call it as per AS 21, it is known as minority interest. As per Ind AS 110, it is called as non-controlling interest, NCI. Now, what is this non-controlling interest or minority? Now, subsidiary means, let's say A Limited is holding 60% of B Limited. Now, remaining 40% is held by some other shareholders. So, those shareholders who are holding remaining portion of shares are known as minority interest or non-controlling interest. Now, while making these permanent consolidation adjustments, auditor has to give particular attention to pre-acquisition reserves, because these pre-acquisition reserves play a very important role in determination of goodwill. Okay, pre-acquisition reserves and also date of acquisition, these two play a crucial role in calculation of goodwill. You would have observed this in your financial reporting while discussing Ind AS 110, consolidated financial statements. There will be lot of sums in that chapter, right? And you should also examine whether pre-acquisition reserves has been properly allocated between the parent entity and the minority interest. This pre-acquisition reserves, they will be bifurcated between parent entity and minority interest as per their sharing ratio, right? So that bifurcation has to be done properly. Next, verify the subsequent changes in these permanent consolidation adjustments on account of subsequent acquisition or disposal of shares. Okay, in future, if the additional shares have been acquired or if the existing shares have been disposed by the parent entity, then the consolidation adjustments, they have to be done again properly. Okay, so these are the two permanent consolidation adjustments. Next, going to current period consolidation adjustments. Before discussing that, there is one point with respect to setting of goodwill with capital reserve. Now, sometimes what happen is, parent entity, it can acquire as many subsidiaries as it want. Now, while acquiring subsidiary 1, goodwill has arisen, and while acquiring subsidiary 2, capital reserve has arisen. Whether these two can be set off, goodwill is debit balance, capital reserve is credit balance, whether you can set off these two and a net figure can be shown in the financial statements, in the consolidated financial statements, answer is yes, you can set off goodwill with capital reserve. But however, if you have set it off, in the notes you should show gross figure of goodwill and gross figure of capital reserve. Okay, that is the requirement with respect to netting of goodwill and capital reserve. Next, current period consolidation adjustments. I have told you now there are 10 current period consolidation adjustments. What are they? Let us discuss. First one, intra-group interest paid and received or management fee, etc. Let's say A Limited is parent entity, B Limited is subsidiary. A Limited has given loan to B Limited. Now, B Limited will pay interest on that loan to A Limited. Now, this interest will be expenditure in B Limited, income in A Limited. Now, that is okay for standalone financials. But while you are preparing consolidated financial statements, both the financials of A Limited, B Limited will be combined. Now, when you have combined, it is not required to separately show interest expenditure, interest income. You can just strike them off. That is the adjustment with respect to intra-group interest paid, received or management fee, etc. Next, unrealized intra-group profits on assets acquired or transferred from two other subsidiaries. Same. Now, A Limited has sold an asset to B Limited, which is a subsidiary, at profit. Now, in the A Limited's book, that profit will be shown. While you are combining both these financial statements, that profit need not be shown. You can just set off the profits on acquisition or selling of assets to components. Next, intra-group indebtedness, same. If A Limited has given loan to B Limited, in B Limited it will be shown liability, in A Limited it will be shown as asset. You can just net off them. Next, adjustment related to harmonization of different accounting policies being followed by the parent and its component. I have told you, inventory valuation, parent is making as cost or inventory, whichever is lower, component is calculating at a cost. So while in consolidated financial statements, you should harmonize them. Okay, you should follow any one type of accounting policy only. Next, that is also current period consolidation adjustment. Now, a question: who will make these current period consolidation adjustments? Management will make. Okay, auditor will not make these current period consolidation adjustments or the permanent consolidation adjustments. Next, in case of foreign component, adjustments to convert foreign gap to gap under which CFS are prepared. This point we have already discussed in responsibilities of management. Okay, it is a responsibility of management to convert foreign gap to Indian gap. Next, determination of movement in equity attributable to minorities. Okay, record deferred tax assets, adjustments of deferred tax assets. Okay, adjustments with respect to deferred tax and recording of deferred tax has to be done by management, and it falls under current period consolidation adjustments. So here we have done with 8 consolidation adjustments. Still there are 2 consolidation adjustments. Let us see. Current period consolidation adjustments with respect to subsequent events. Now what is this? Adjustments to the financial statements of a parent and the components being consolidated for recognized subsequent events or transactions that occur between the balance sheet date and the date of auditor's report on the consolidated financial statements of the group. Now, the balance sheet date, the balance sheet or the financials of component and the parent will be prepared as on 31st March 2024. That will be the balance sheet date of both CFS and standalone financial statements. They will be prepared as on that date. Now let's say on standalone financial statements, audit report has been given on 30 May 2024. On consolidated financial statements, audit report is being given on 30 June 2024. Now, all the subsequent events that occur between 31st March 2024 and 30 June 2024 has to be adjusted in the consolidated financial statements. Okay, whereas in the standalone financial statements, only those subsequent events that occur between 31st March 2024 and 31st May 2024 will be included, right? So this is the adjustment with respect to subsequent events. There is another adjustment with respect to subsequent events. Adjustment for the effect of transactions or other events that occur between the date of components and the balance sheet and not already recognized in the financial statements and the date of the auditor's report on the group's consolidated financial statements. Then the financial statements of the component are not drawn up to the same balance sheet date as of the parent. What is this? Now, sometimes what will happen is the financial statements of components, it will be prepared as on 31st December. Generally, the financial statement should be prepared as on 31st March, but in some countries, the companies, they will prepare the accounting period for them will be 1st January to 31st December. So the Indian company, it is having a foreign subsidiary which has prepared its financial statements as on 31st December, but consolidated financial statements has to be prepared as on 31st March. Now, in the consolidated financial statements, all the events that occurred between 31st December and 31st March with respect to that subsidiary should be included. Okay, even they will be considered as subsequent events. So this adjustment is also current period consolidation adjustment. Hope you understood. Again, I'll explain with the help of a timeline. See, the balance sheet of component has been prepared as on 31st December 2023. Okay, and consolidated financial statements and also the parent entities financial statements, they will be prepared as on 31st March 2024. Now you need to consolidate this financial statement and this financial statement, right? Parent entity financial statement and component financial statements, and prepare consolidated financial statements as on 31st March 2024. But balance, the financials of component are available only till 31st December 2023. Now all the transactions of component that occurred between this period should be adjusted in the consolidated financial statements. Okay, This you need to adjust, and this however you will adjust. Okay, audit report on consolidated financial statements is being given on 30 June 2024. So the events that occur between the date of balance sheet and the date of auditor report, they will be subsequent events. Okay, these events you will however adjust, but along with them, with respect to component, even this event should also be adjusted. Okay, this is a adjustment with respect to subsequent events. Next, impairment loss with respect to goodwill. Now, with respect to goodwill, for each and every year, you need to verify whether there is a impairment loss. Okay, goodwill is to be tested for impairment loss at every balance sheet date. You should also test whether impairment in the goodwill has occurred because of intra-group losses. Okay, because of loss in the subsidiary, whether the goodwill will get impaired, you need to test that. Next, examine whether any impairment loss has been determined by the parent. If yes, examine the procedure followed. Okay, if the parent has already determined the impairment loss, you need to see the procedure that has been followed by the parent. Next, in case the impairment loss has been determined in foreign currency, okay, let's say impairment loss has occurred with respect to foreign subsidiary, then you will calculate the impairment loss in foreign currency only. Now, while preparing CFS, that impairment loss has to be converted into Indian currency. Now, while converting that foreign currency into Indian currency, there will be certain loss that might occur, which you will call as currency translation loss. Okay, at the time of recognizing, the value of INR to dollar will be different with when compared to the value of INR to dollar at the time of preparing financial statements. So while you convert the foreign currency, while you convert the impairment loss that has been recognized in foreign currency into Indian currency, certain currency translation loss can occur, right? So that needs to be transferred or adjusted from currency translation reserve. Okay, next we have another topic with respect to consolidated financial statements, which is reporting. Okay, that aspect we will see from book. Let me open the book now. Regarding reporting, basically if you see here, there are 5 scenarios. So in each of these scenarios, how should the auditor will report, what considerations has to be taken into account by the auditor. Let us discuss each scenario wise. When the parent's auditor is also auditor of all its components, see, when the auditor who is auditing the financial statements of parent is also the auditor of all the uh, components financial statements. So in such a situation, how will the principal auditor reports, what considerations he needs to take into account? See, first of all, whether principles and procedures for preparation of CFS laid down in the accounting standards have been followed or not. You need to verify whether the CFS have been prepared as per applicable financial reporting framework or not, and you should see the requirement as per SA 705. If at all there is any deviation between CFS and the applicable financial reporting framework, and you should also examine whether these CFS are showing true and fair view or not. Okay, this is with respect to the reporting aspect. When the parent auditor is also auditor of all its components, okay, he needs to see whether financial statements CFS are showing true and fair view or not, whether CFS prepared as per applicable financial reporting framework or not. If applicable financial reporting framework is not followed, then you need to check the requirements of SA 705, that is modification of opinion. Next, when parent's auditor is not the auditor of all its components, okay, the consolidated financial statements are being prepared by or being audited by one auditor, and components are audited by some other auditor. In this situation, what should be the reporting consideration of the parent auditor or the principal auditor? Now, the auditor of CFS should consider requirement of SA 600, that is using the work of other auditor. Since the auditor of components is different, the principal auditor is using the work of those component auditors, you need to consider the requirement of SA 600. Next, As per SA 706, if the auditor considers it necessary to make reference to the audit of other auditors, he can make such reference in other matter paragraph, and also you will have to refer the magnitude of portion of financial statements audited by other auditor. See, the component financial statements are audited by other auditor. Now that work is being used by principal auditor. Now in the principal auditor, in his report, he can mention that this much amount of financial statements are audited by some other auditor. Okay, you can represent this in the form of assets or in the form of you know liabilities. You can represent like of total assets, 40% of assets audited by some other auditor. Like this you can quantify the amount of financial statements audited by some other auditor. See, this may be done by stating aggregate rupee amounts or percentage of total assets, revenues, cash flows of components included in the CFS not audited by parents auditor. Okay, you will include the financial statements of component in the consolidated financial statements. So how much percentage of those total assets or total revenue or total liabilities audited by some other auditor, you can mention it in the audit report under other matter paragraph. And such a reference shall not be construed as a qualification. Okay, just because of the fact that you are referring to the work done by other auditor in the audit report under other matter paragraph, it doesn't mean that you are qualifying your opinion. Okay, next, when components auditor reports on financial statements under accounting framework different than that of parent. Now the components have prepared their financial statements as per a different accounting framework, whereas parents financial statements are prepared in a different accounting framework. Now in this situation, you have to, the management of the parent entity has to convert, gap conversion I have told you na. So have to convert the financial statements of a component into the accounting framework that is being followed by the parent entity, and those conversion adjustments will be audited by the principal auditor. See, financial statements are prepared under a accounting framework that is different than that of framework used by the parent, then parents management shall perform a conversion of audited financial statements from framework used by component to the framework under the consolidated financial statements. Now these conversion adjustments are audited by the auditor. This is one option. Another option is the component itself can prepare its financial statements as per the accounting framework that is followed by the parent entity, and those financial statements will be audited by the principal auditor. See, alternatively, on the basis of prepare, the component will prepare financial statements on the basis of parents accounting policies as outlined in the group accounting manual. Now the local component auditor can then audit and issue audit report on components financial statements prepared in accordance with group accounting policies. Okay, so any of these two alternatives will be used if the component has prepared its financial statements as per a different accounting framework. Next scenario, when component auditors report under auditing framework different than that of parent. See, in the previous scenario, the components have prepared financial statements under different accounting framework. Now in this scenario, auditor, the component auditor is auditing the components financial statements under different auditing standards. Now the financial statements should be strictly audited only as per the Indian auditing standards for the purpose of consolidating them into the consolidated financial statements. Now here the principal auditor, he needs to ask the management to get those components financial statements audited as per Indian auditing standards, and only then the audit report that the component auditor has given will be used by the principal auditor. Okay, you can find it, find it here. Okay, they should also be audited under framework that corresponds to Indian gas means generally accepted auditing standards. Next, components are not audited. See, if components of financial statements are not audited, then the principal auditor, he cannot obtain audit evidence with respect to component financial statements. Okay, why he needs to obtain audit evidence with respect to component financial statements? Because they are included into CFS while preparing CFS. So, if the components are not audited, the auditor of CFS cannot obtain sufficient appropriate audit evidence. So, he needs to consider the opinion that he has to give on CFS. Okay, he needs to give modified opinion because he is not able to obtain sufficient appropriate audit evidence. Next, essay 600, using the work of another auditor. Now you already know these definitions: principal auditor, other auditor, component. These definitions you already know. Purpose of essay 600. See, the essay 600's purpose is to establish standards when principal auditor uses to decide the other auditor's work. Okay, how there should be coordination between principal auditor and other auditor, and what communications has to be there between principal auditor and other auditor, and what should be considered by principal auditor when he decides to use the work of other auditor. All these aspects, with respect to all these aspects, essay 600 will establish standards. Now, what matter should be considered by principal auditor while he accepts the audit of consolidated financial statements? Let us see. Materiality of a portion of financial information which the principal auditor audits. Now, in the consolidated financial statements, components financial statements will also be included, which will be audited by component auditor. Now, apart from that component financial statements, how much of the CFS should be audited by the principal auditor? So that materiality needs to be considered. Next, principal auditor's degree of knowledge regarding business of components should also be considered. Next, risk of material misstatement in the financial information of the components audited by other auditor. Okay, what is the risk of material misstatement in the financial statements that are audited by component auditor? Next, the performance of additional procedures as set out in this essay should also be considered by the principal auditor before he accepts the work. Next, principal auditor's procedures. What procedures principal auditor will perform? He will visit component and he will examine books of accounts of the component. He will consider professional competence of other auditor. Now, other auditor has audited the component financial statements. Whether the other auditor is capable and what knowledge the other auditor is having, the competency of the other auditor will be considered by the principal auditor. He will perform procedures to obtain sufficient appropriate audit evidence that work of other auditor is adequate for principal auditor purposes. The other auditor, he has audited the components, but whether that work which other auditor has performed is useful for the purposes of the principal auditor or not, this also will be checked. Next, the principal auditor, he will discuss with the other auditor with respect to what procedures other auditor has performed in the audit of component financial statements. Next, principal auditor should consider significant findings of other auditor. Next, communication by principal auditor with other auditor. See, there should be proper liaison between principal auditor and other auditor. Liaison means proper coordination. Now, principal auditor may find it necessary to issue written communication to the other auditor. Okay, principal auditor can communicate with the other auditor through written communication. Principal auditor should advise other auditor of matters that may come to his attention that he thinks are necessary for the purpose of audit of other auditor. Okay, now principal auditor, while conducting his audit of CFS, if he finds any matter and if he feels that this matter is necessary for the purpose of audit of a component auditor, then principal auditor has to communicate this matter to the other auditor. Next, the principal auditor may require the other auditor to answer a detailed questionnaire regarding matters on which principal auditor requires information. Okay, if in case the principal auditor prepares any questionnaire, then the other auditor has to answer those questionnaire. Next, coordination of work of other auditor and the principal auditor. Now, the Other auditor, if at all he finds any significant findings, he needs to communicate them to the principal auditor. Okay, communicate the significant findings. Next, other auditor should follow the timetable, that is within the given time limit he should complete the audit of component. Next, ensure compliance with relevant statutory requirements. Okay, other auditor should comply with all the statutory requirements. And if in case the principal auditor has sent any questionnaire, the other auditor should answer that questionnaire. Okay. Next, division of responsibility. Now, principal auditor would not be responsible in respect of work entrusted to the other auditor. Okay, the other auditor is responsible for the audit of component. So, with respect to audit of component, principal auditor will not have any responsibility. Now, except in circumstance which should have aroused the suspicion about the reliability of work performed by the other auditors. However, if principal auditor gets any suspicion with respect to the work that is done by the other auditor, then with respect to that work where there is a chance of occurrence of suspicion, okay, with respect to that work, the principal auditor will also be responsible. Okay, just by seeing itself you can find out that there is misstatement in the components financial statements, but principal auditor has kept silent because the components financial statements responsibility is not the responsibility of principal auditor. This should not be done. Okay, if there is a chance of arouse of suspicion and even then you kept silent, then you will, the principal auditor will also be responsible with respect to that work, even though that work has been allocated to other auditor. Okay. Next, when principal auditor has to base his opinion on the financial information on the entity as a whole, he can make a reference to the point that there is a division of work that has been done, wherein in the consolidated financial statements, components financial statements have also been included, and the responsibility to audit component financial statements lies with other auditor. Like this, he can mention the division of responsibility for the financial information of the entity by indicating extent to which financial information of component audited by other auditor. Okay, how you will quantify percentage of asset, percentage of liability. Okay, this much percentage of total assets have been audited by component auditor, this much percentage of total revenue is audited by component auditor. Like this, you have to quantify and you can refer to the fact that there is a division of responsibility. Next, reporting considerations. When principal auditor concludes that work of other auditor cannot be used and unable to perform additional procedures regarding financial information of the component audited by other auditor, then the principal auditor should express qualified opinion or disclaimer of opinion. See, the principal auditor, he is not able to use the work of other auditor, and also he is not able to obtain audit evidence with respect to the component by performing alternate procedures. In this situation, he is not having audit evidence, and if the misstatement is material, he will give qualified. If at all there are any misstatements and those misstatements will be material as well as pervasive, he will give disclaimer of opinion. Okay, now in all circumstances, if other auditor issues or intends to issue modified audit report, the principal auditor should consider whether subject of modification is of such nature and significance that it requires modification in principal auditor reports also. Now, if component auditor in his audit report on component has given modified opinion, then principal auditor should consider whether modification given by the component auditor is of such a significance and is of such an importance that the principal auditor should also modify his opinion on the CFS. He needs to consider it before giving opinion on the consolidated financial statements. Okay, so by this we have completed revision of SA 600 also. Okay, we have completed revision of group audit and SA 600. Before winding up the class, there is a small announcement. We have launched Lecturepedia app. On this app, you can solve MCQs of all the subjects of CA Final, CA Inter and CA Foundation. And on this app, you can also purchase classes of various faculties. Okay, you can download this Lecturepedia app from Play Store, and we'll meet in the next revision class. Until then, take care. Bye bye. See you.